January 8th, 2026. A date that will be remembered. 1,624 institutional entities did something that should be statistically impossible. They abandoned the future. They paid premiums they shouldn't have paid. They accepted costs they shouldn't have accepted. All to grab physical silver right now, not in March, not in 60 days, now. 8 to 12 million ounces. Vanished from the vault in 24 hours. This isn't speculation. This is fear. And the data proves the system just broke. Welcome to Currency Analyzer. If you've made it this far, you understand that markets speak in whispers before they scream. May I ask you something? The way one might ask a trusted advisor over coffee. Would you consider subscribing to this channel? We don't chase headlines here. We dissect the machinery beneath them. And before we proceed with what might be the most critical market analysis you'll hear this month, I'm genuinely curious, from which corner of the world are you watching this? London? Singapore? New York? Mumbai? Drop your location in the comments, because what we're about to discuss affects every market, everywhere. Now, let's examine exactly what happened on January 8th and why it changes everything. The trading screens closed on Friday, January 9th, 2026, showing silver at $80.17 per ounce. A massive green candle, up 4.6% in a single session. Across social media platforms, the sentiment was clear. Celebration. Traders were high-fiving. Reddit threads were exploding with excitement. The bull market was finally back, or so they thought. But while the crowd was watching the scoreboard, the stadium was quietly burning down, deep inside the technical clearing reports of the CME Group, a document that most traders never bothered to read. Something extraordinary had just been recorded. Something that doesn't happen in normal markets. Something that suggests the entire silver futures system is approaching a critical failure point. The data was simple, yet devastating. For the trade date of January 8th, 2026, 1,624 delivery notices were issued. To the untrained eye, this might seem like just another number, just another line item in a bureaucratic report. But to those who understand the mechanics of futures markets, this number represents a seismic shift in institutional behavior. Each of those contracts represents 5,000 ounces of physical silver. Do the mathematics. 1,724 contracts multiplied by 5,000 ounces equals 820,000 ounces. That's over 8 million ounces of physical silver that institutional entities demanded for immediate delivery in a single 24-hour period. In January. January is what market professionals call a non-delivery month. It's a quiet month, a month where serious players are supposed to be positioning themselves in March contracts. Where the real liquidity lives, January is where positions wind down, not where they explode. Yet here they were, 1,624 sophisticated entities, standing up in the middle of a supposedly dormant month, slamming their fists on the table, demanding their metal right now. This is what analysts call backward rolling, and it almost never happens. In a normal functioning futures market, time flows in one predictable direction. As a contract approaches expiration, traders execute what's called a forward roll. They sell the expiring month, let's say January, and they buy the next active month, let's say March. This is standard procedure. Why? Because most futures traders are speculators, not industrial users. They don't want the physical metal. They don't want to arrange armored trucks, pay for vault storage, hire security guards, deal with insurance policies. They just want exposure to the price movement. So they roll forward, pushing their obligation into the future, month after month, year after year. This is how the paper silver market has functioned for decades. The banks rely on this behavior. They rely on the fact that 99% of contract holders will never ask for physical delivery. They can sell far more paper contracts than they have physical metal to back them, because they know the metal will never be requested. It's a fractional reserve system, applied to commodities. But on January 8th, that system hit a wall. Instead of rolling forward into March, these 1,624 entities did something radical. They rolled backward. They abandoned their positions in the liquid, safe, comfortable March contract. They paid transaction fees they shouldn't have paid. They accepted storage costs they could have avoided. They took on the logistical nightmare of immediate settlement, all to get their hands on physical silver right now. Not in 2 months. Now. This is not normal market behavior. This is panic behavior. When a sophisticated institutional investor is willing to pay premiums and accept inefficiencies just to accelerate delivery, they are sending a signal. That signal says, I do not trust that the metal will be available in the future. That signal says, I believe the vault might be empty by March. That signal says, time has become my enemy. The data doesn't lie. While 1,624 contracts appeared in January demanding immediate delivery, the March contract bled 2,763 contracts. Money wasn't leaving the silver market entirely. It was fleeing from the future into the present. Capital was abandoning the promise of tomorrow to seize the certainty of today, even the ghost month of February, a contract that typically sees almost zero trading volume because it sits awkwardly between active months, suddenly absorbed 378 new contracts. Traders were so desperate to cut the timeline, so anxious to reduce their exposure to future uncertainty, that they were willing to park their money in an illiquid dead month, just to be 30 days closer to physical possession. This is the behavior of fear. This is what happens when trust breaks. And the question that should be keeping every bullion bank executive awake at night is simple. If 1,624 entities panicked in January, how many will panic in March? The silver futures market operates on a principle that most people never question. Trust, not the warm, fuzzy kind of trust between friends, but cold, calculated institutional trust. The trust that when a trader buys a contract promising delivery of 5,000 ounces of silver in March, those 5,000 ounces actually exist somewhere. The trust that the vault isn't empty. The trust that the promise on paper equals reality in metal. For 50 years, this trust held the entire system together. But trust, once broken, doesn't heal overnight. And the data from January 8th reveals something far more disturbing than just a spike in deliveries. It reveals the exact moment when that trust began to shatter. To understand what happened, one must first understand the economic architecture of the futures market itself. In normal market conditions, there exists a pricing structure called contango. Contango is when the future price of a commodity sits higher than the spot price, the price for immediate delivery. This makes logical sense. If someone wants silver delivered in March instead of today, they should pay a premium. Why? Because holding physical silver costs money, vault rental fees, insurance premiums, security expenses, transportation logistics. These are real costs that someone must bear. So the March contract traditionally trades at a higher price than immediate delivery, compensating whoever holds the metal for those 2 months. This price difference encourages a predictable behavior pattern. Traders naturally gravitate toward future contracts, and they avoid the immediate delivery months because those come with headaches, with costs, with physical responsibilities. The system runs smoothly because everyone follows the same incentive structure. Roll forward, avoid the metal, stay in the paper game. But something fundamental changed in the past 48 hours. The incentive structure inverted. The economic force that keeps traders in future contracts, that keeps them rolling forward month after month, suddenly reversed direction. Economists call this shift a convenience yield spike. Convenience yield measures the benefit of holding a physical asset versus holding a paper claim on that asset. In stable markets, the convenience yield of physical silver is low or even negative. Why hold a heavy bar when a paper contract does the same job without the storage fees? But when supply becomes uncertain, when trust in future delivery erodes, the convenience yield explodes. Suddenly, the benefit of having metal in hand right now outweighs every cost associated with holding it. The vault fees don't matter anymore. The insurance premiums become irrelevant. The armored truck expenses fade into background noise because all of those costs are finite, calculable, manageable. But the risk of not having the metal when you need it, that risk becomes infinite. This is what happened on January 8th. The 1,624 entities that executed backward rolls were making a mathematical statement. They were saying, the cost of waiting is now higher than the cost of possession. They looked at the March contract, with its comfortable 2-month cushion, its deep liquidity pool, its apparent safety, and they saw danger. They saw a piece of paper that might become worthless if the vault runs dry before March arrives. So they paid the penalty. They crossed the bid-ask spread, ate the transaction fees, accepted the storage costs, all because possession had become more valuable than promises. The technical data confirms this psychological shift with brutal clarity. March lost 2,163 contracts in a single day. That's not profit-taking. That's not normal position adjustment. That's exodus. Capital doesn't flee the most liquid contract on the board unless something is fundamentally wrong. Meanwhile, January absorbed massive buying pressure despite being an expiring contract. The volume data shows 1,147 contracts traded on the Globex electronic system in January alone. Think about that for a moment. January is supposed to be a dead month by the second week. The liquidity should be approaching zero. Yet nearly 1,500 entities were frantically trading in a contract that was literally days from expiration. Why? Because they were racing to grab delivery slots before the door slammed shut. They were converting paper into metal while the conversion was still possible. Even February, the forgotten ghost month that sits between active contracts, suddenly came alive. 378 new contracts appeared. Traders who would normally never touch February were parking their capital there, accepting zero liquidity, accepting terrible pricing, just to shave 30 days off their wait time. This is not speculation. This is survival behavior. This is what happens when institutional players stop believing in the system's ability to deliver. The mathematics of the situation creates a vicious cycle that feeds on itself. Every backward roll drains inventory from the vault. Every ounce that gets delivered is one less ounce available for future contracts. And as the inventory shrinks, the fear grows. Other traders see the delivery notices piling up. They see the open interest in March bleeding. And they ask themselves a simple question. If I wait until March, will there be any metal left? That question creates urgency. That urgency creates more backward rolls. More backward rolls drain more inventory, and the cycle accelerates. The banks, the institutions that sold these contracts, find themselves trapped. They cannot refuse delivery without triggering an immediate default. They cannot magically create physical silver out of thin air. They cannot slow down the exodus without destroying what little trust remains. So they watch, helpless, as their vaults empty, one contract at a time, one backward roll at a time. 8.12 million ounces gone in a single day. And March is still 6 weeks away. The critical question isn't whether the system can survive this pressure. The critical question is, where is all this metal actually going? There's a law in physics that governs the movement of all matter in the universe. Objects flow from areas of low pressure to areas of high pressure. Water seeks its level. Heat moves toward cold. Capital chases return. And right now, silver is flowing east. Not slowly, not gradually, but in a torrent. The 8.12 million ounces that vanished from COMEX vaults on January 8th didn't simply disappear into private collections or safety deposit boxes across America. They embarked on a one-way journey across the Pacific Ocean to understand why 1,724 sophisticated entities chose to execute backward rolls, paying premiums they shouldn't have paid, accepting costs they could have avoided. One must understand the gravitational force pulling that metal eastward. That force has a name, the Shanghai Premium. On Friday, January 9th, 2026, while traders in New York were celebrating silver closing at $80.17 per ounce, a very different price was being paid on the other side of the world. At the Shanghai Gold Exchange, physical silver was changing hands at approximately $87 per ounce, $7 higher, for the exact same metal. Same purity, same weight, same commodity, but two completely different prices, separated by nothing more than geography. This price dislocation creates what professional traders call an arbitrage opportunity. And this particular arbitrage opportunity is almost obscenely profitable. The mathematics are simple. Buy silver in New York at $80, ship it to Shanghai, sell it for $87. That's an immediate profit margin of 8.75% per transaction. No speculation required, no market timing needed, no technical analysis necessary, just pure risk-free profit, assuming one can actually get their hands on the physical metal. And therein lies the problem. The only bottleneck in this infinite money machine is physical possession. A trader cannot arbitrage a paper contract. They cannot buy a COMEX futures position and magically teleport it to China. They must convert that paper into metal, take delivery, arrange shipping, clear customs, and deposit the bars into a Shanghai vault. Only then does the arbitrage close. Only then does the profit materialize. This explains the backward rolling phenomenon with perfect clarity. The entities rushing into January contracts aren't just scared of a default. They're racing against time to capture this arbitrage before the window slams shut. Every day they wait is a day of lost profit. Every day they delay is a day that export restrictions might tighten, that shipping routes might close, that the Chinese government might adjust its policies. So they're cannibalizing the March contract, draining the future to feed the present, because the present is where the money is. But this isn't just about profit margins. It's about strategy. China didn't accidentally create a $7 premium. They engineered it. On January 1st, 2026, the Chinese government implemented comprehensive export controls on critical minerals. Silver, classified as essential to national security, fell under these new restrictions. The policy was clear. What enters China stays in China. But the policy said nothing about stopping imports. China continues to welcome foreign silver with open arms. They're absorbing every ounce the West will sell them. They're using their massive trade surplus, their currency reserves, their state-backed purchasing power to kind of vacuum the global silver supply into their vaults. And once that silver crosses into the Shanghai Gold Exchange ecosystem, it's gone. Permanently removed from Western markets, a one-way valve that only flows east. The strategic reasoning behind this accumulation becomes obvious when examining China's industrial priorities. Solar panel manufacturing, the cornerstone of their renewable energy dominance, consumes massive quantities of silver. Every photovoltaic cell requires silver paste for conductivity. Battery technology, essential for their electric vehicle ambitions, demands silver for thermal management systems. Semiconductor production, the foundation of their technological sovereignty, relies on silver for advanced circuitry. China has done the mathematics. They've calculated how much silver they'll need over the next decade to maintain their manufacturing supremacy. And they've realized something that Western policymakers are only beginning to understand. Silver isn't just a precious metal anymore. It's the new oil. Control the silver supply. Control the green energy transition. Control the green energy transition. Control the global economy. So they're willing to pay a premium. They're willing to create price dislocations. They're willing to act as a gravity well, pulling metal out of Western vaults with relentless economic force. And the Western banking system, for all its sophistication, for all its decades of price management, is utterly powerless to stop it. JP Morgan cannot refuse to honor delivery requests. The COMEX cannot change the rules mid-game without destroying the market's credibility entirely. The bullion banks cannot tell a trader, no, you can't ship that silver to China, without triggering immediate legal challenges and market panic. So they're forced to comply. They're forced to watch as bars leave their vaults. They're forced to hand over physical inventory to entities they know full well are exporting it to Shanghai. One delivery notice at a time, one backward roll at a time, the vault inventory ticks downward. And here's where the situation becomes genuinely dangerous. The Western banks have been operating under an assumption for decades. The assumption that only a small percentage of paper contracts would ever convert to physical delivery. They've sold far more paper silver than they have metal to back it. This fractional reserve approach works perfectly, as long as trust remains intact. But trust is evaporating. The backward rolling proves it. And as trust dies, the demand for physical conversion rises. More traders abandon paper. More entities demand metal. More inventory drains from the vault. The Shanghai premium acts as a constant pull, a gravitational force that never sleeps. Every minute of every day, arbitrage traders are calculating whether they can extract metal from New York and deliver it to China before the spread narrows. And as long as that $7 gap exists, the pressure continues. The vacuum intensifies. The one-way valve keeps pumping. Western vaults continue bleeding. The banks can try to suppress the paper price. They can attempt to shake trader confidence with overnight volatility. They can paint the charts red to scare the retail crowd. But every time they push the COMEX price down, they achieve the opposite of their intended goal. They widen the spread with Shanghai. They make the arbitrage more profitable. They strengthen the vacuum cleaner. They accelerate the very drain they're trying to prevent. The system has entered a death spiral. And the March contract, sitting there with 800 contracts of open interest, represents the next wave. If even a fraction of those contracts decide to roll backward, if even 10% of that open interest demands physical delivery, the vault won't just drain, it will empty completely. And when the vault empties, when the last bar leaves the Western ecosystem, the price in New York will have no choice. It will gap up overnight. It will converge with Shanghai. Not gradually, not smoothly, but violently. A forced repricing event that closes the arbitrage by destroying the illusion that paper and physical are equivalent. The question isn't if this happens. The question is when. The silver market stands at a crossroads that only appears once in a generation, perhaps once in a lifetime. Every piece of evidence examined thus far, the backward rolling, the convenience yield explosion, the Shanghai vacuum, points to a single inescapable conclusion. The current price structure is unsustainable, not because of speculation, not because of hype, but because of mathematics. Cold, brutal, unforgiving mathematics. The 80.17 closing price on January 9th represents something far more significant than a rally or a breakout. It represents the beginning of a forced repricing event, a market correction in the truest sense, where an artificial price must violently adjust to meet physical reality. The pathway to $100 per ounce is not a prediction. It is a mechanical inevitability. Here is why. The COMEX system currently holds approximately 102,800 contracts of open interest in the March delivery month. Each contract represents 5,000 ounces. Multiply those numbers, 514 million ounces of theoretical demand. Now examine the actual physical inventory available for delivery. The registered silver, the metal actually available to satisfy delivery requests, sits at a fraction of that number. The exact figures fluctuate daily, but the ratio is catastrophically imbalanced. There's not enough physical silver in the vault system to satisfy even 20% of the paper claims against it. This imbalance has existed for years. The banks have managed it successfully because they relied on forward-rolling behavior. They relied on traders voluntarily pushing their obligations into the future. But January 8th proved that behavior pattern is breaking down. When 1,724 entities execute backward rolls in a single day, When 8.12 million ounces demand immediate delivery in a supposedly quiet month, it signals that the voluntary cooperation keeping the system alive is collapsing. Fear is replacing cooperation. Hoarding is replacing speculation. And once that psychological shift begins, it becomes self-reinforcing. The traders who rolled backward in January won't suddenly develop renewed faith in March contracts. If anything, they'll become more aggressive. They'll encourage others to follow their lead. They'll share their research, their concerns, their strategies. And slowly, then suddenly, the March contract will face the same pressure January just experienced. More backward rolls, more delivery demands, more vault drainage. But March is different from January in one critical aspect. March is a major delivery month. It's where the real volume sits. If January, a non-delivery month, saw 1,624 contracts stand for delivery, what happens when March arrives with 100 times that open interest? The mathematics become terrifying. Even if only 5% of March contract holders demand physical delivery, that's over 5,000 contracts. That's 25 million ounces. The vault doesn't have 25 million ounces available. Not even close. Which means one of two outcomes becomes unavoidable. Either the banks refuse delivery, triggering an immediate default and destroying the COMEX's credibility forever, or they honor the deliveries, draining the vault to zero and pricing themselves out of future business. Neither option is sustainable. Both lead to the same destination. A price spike that closes the gap between paper promises and physical reality. The Shanghai premium provides the target. Currently, sitting at $80 per ounce, it represents the true clearing price for physical silver in a market where supply is constrained. The COMEX price will converge with Shanghai, not because of manipulation, not because of conspiracy, but because arbitrage forces it to. As long as New York trades below Shanghai, entities will continue extracting metal from COMEX vaults and shipping it east. The drain continues until equilibrium is reached. That equilibrium sits somewhere north of $100 per ounce. Why $100 specifically? Because that number represents more than just a price point. It represents a psychological barrier. Once silver crosses into triple digits, it triggers a cascade of behavioral changes that accelerate the repricing. Mainstream media begins coverage. Financial advisors start recommending allocation. Retail investors, currently unaware of the backward rolling crisis, suddenly take notice. Industrial users, the solar manufacturers, the defense contractors, the battery producers recognize their supply chain vulnerability, and they panic, not to speculate, but to secure inventory. They enter the market with one directive: acquire physical silver at any price. Because, for an industrial entity, the cost of silver is irrelevant compared to the cost of shutting down production. A solar panel manufacturer will pay $100 per ounce. They'll pay $120. They'll pay whatever is necessary to keep their factories running. Because the alternative, halting production, missing delivery deadlines, breaking contracts, is bankruptcy. This industrial buying pressure, once it begins, becomes unstoppable. It's not driven by profit motive, it's driven by survival, and survival bidding has no ceiling. The timeline for this convergence is compressing rapidly. January's backward rolling was the warning shot. February will see increased pressure as more entities recognize the pattern. March will be the inflection point, the month where theory meets reality, where paper claims confront physical limits, where the COMEX either delivers or defaults. For individuals watching this unfold, for business leaders managing currency exposure, for entrepreneurs building wealth, the strategic implications are clear. The window of opportunity is not measured in years. It's measured in weeks, perhaps days. The entities executing backward rolls in January understood something critical. They understood that time has become the enemy. Every day of waiting increases the risk that the vault empties before their turn arrives. Every day of delay raises the probability that emergency measures, capital controls, export restrictions, delivery suspensions intervene. So they acted, they paid premiums, they accepted costs, they secured metal while securing metal was still possible. The banks will attempt to fight this trend. They'll try to suppress the paper price through overnight futures manipulation. They'll create volatility designed to shake confidence. They'll paint charts red, trigger stop losses, create the illusion that the rally is over. But each attempt backfires. Each suppression of the COMEX price widens the Shanghai spread. Each widening of the spread strengthens the arbitrage incentive. Each strengthening of arbitrage accelerates the vault drain. They're trapped in a feedback loop of their own creation, a system that worked perfectly for 50 years. As long as trust remained intact, now works in reverse. Now it amplifies the very crisis it was designed to prevent. The destination is mathematically certain. $100 silver is not a ceiling. It's a checkpoint. A milestone on a journey that ends only when physical supply and paper demand reach equilibrium. And that equilibrium, given current supply constraints, given Chinese accumulation, given industrial demand acceleration, sits well above triple digits. The backward rolling of January 8th will be remembered as the moment the illusion shattered, the moment when sophisticated money stopped believing in paper promises, the moment when possession became the only strategy that mattered. The vault is draining, the March deadline approaches, the Shanghai vacuum intensifies, and the price, currently resting at $80, has only one direction left to travel, upward, inevitably, unavoidably, toward the convergence point where Western paper meets Eastern physical reality. The signal has been sent, the data has been recorded, the mechanism is in motion, and nothing short of a complete system redesign can stop what has already begun.